Hello, and welcome to this session. In this session, we'll be talking about cost management basics. And in this session, we're going to be talking about the basics that provide a foundation for managing costs. Managing costs, we have to be aware of how costs behave, what types of classifications they are. So we want to get a good foundation in how costs behave, how costs flow, so that we can understand and make better decisions in the future. So let's take a look at some basic terminology of cost management. First of all, we have a cost. A cost is a resource foregone to achieve a specific objective. For example, if I go out and I buy a brand new car for $25,000, what is that cost of the car? $25,000. That's the money I'm giving up in order to get that specific objective. And what is that specific objective? To get a new car so I can drive. So a couple costs. We're going to talk about an actual cost and a budgeted cost. Now, an actual cost is a cost that we have already incurred. We've already incurred them, so we cannot go back and undo the purchase. Now, a budgeted cost, on the other hand, is something that we're planning to forego to achieve a specific objective. So in my example with the car, the actual cost of the car, the purchase of a car would be an actual cost because I've already purchased a car. But what if I haven't purchased a car yet? If I haven't purchased a car yet, and I'm just planning on doing it at some point in the future, I may even have a specific date in the future where I plan on buying that car. But because I haven't actually bought it yet, then that cost is a budgeted cost. Next term we want to talk about is cost object. What is a cost object? Well, a cost object is simply anything for which a measurement of cost is desired. And this can range from a simple bottle of soda to a house. It can be a car on the assembly line. It can be anything at all for which a measurement of cost is desired. Now we're going to talk about cost accumulation, and that means is just a simply gathering of information, cost information and data in an organized way by means of some type of accounting system. Most every company has some type of accounting system, whether it's a small company, may be very rudimentary compared to other companies that are larger, but we have some type of accounting system in which to record those costs. So cost accumulation is simply the gathering of cost information and data in some organized way by means of an accounting system. So let's talk about some cost classifications. Direct costs. These are costs that are related to the cost object and that can be traced to it in an economically feasible manner. These costs are assigned to the cost object by directly tracing these costs. So in other words, looking at the house here, what are some costs that we can easily trace to the house? Well, one thing would be doors, because you will have, 2 doors, maybe 3 doors, front door, back door. Those are costs that we can easily trace to the house. What about windows? We can count the windows and easily trace the number of windows we have on the house. And then we have indirect costs. These costs are related to the cost object, but cannot be traced to it in an economically feasible manner. And these costs are assigned by the process of allocation to the cost object. So indirect costs then are costs related to the building of the house in our picture here, but we cannot feasibly and economically trace these costs. What were we talking about? Well, maybe the number of nails that are holding up the siding. What about glue for the floors, the linoleum floor? There's a number of things that cannot be traced. What about the workers who are just like the supervisor? We can't trace the cost of the supervisor to building this particular house in a feasible manner. Because most likely the supervisor, the general contractor, is going to be overseeing a number of different houses. So let's talk about some direct costs. there's two types of direct costs: direct materials and direct labor. Let's take a look at direct materials. Direct materials. This is the cost of acquiring materials that would become part of the cost object, and it can be traced to the cost object in an economically feasible manner. So what are we talking about? The cost of acquiring materials, acquiring the metal, whatever it is, that will become part of the final cost object, and we can trace those costs to the cost object in an economically feasible manner. In this illustration here, we have a Chevy Silverado. So what are some direct materials? Well, windows, doors, tires, bumpers. Each car has got to have two bumpers, front bumper, back bumper. This truck will have 4 tires and maybe a 5th one for a spare. What about mirrors? Well, the vehicle will have one left mirror for the one passenger side mirror, and then a rear view mirror. What about headlights? Well, only going to be 2 sets of headlights on the vehicle. Engines, each vehicle is going to have its own engine. Transmissions. So these are direct material costs for the Chevy Silverado. So those are some examples of direct materials. What about direct labor? What would we consider direct labor costs for the Chevy Silverado if that is our cost object and we want to gather all the costs associated with making the Chevy Silverado? We've already looked at the materials. Let's look at the labor. Well, the direct labor is simply the cost of compensation for all manufacturing labor that can be traced to the cost object in an economically feasible manner. So what is an example of that? Well, direct labor for the making of the Chevy Silverado are the wages of the people who are on the assembly line actually putting the truck together. So if you've ever seen an assembly line, you'll notice you should know that the vehicles slide and are transported down from one end of the factory to the other. One person will put on a tire, another person will put on a door, another person will put on a mirror. Those are examples of direct labor because they are actually directly involved in the putting together and the assembly of that Chevy Silverado. Now let's talk about manufacturing overhead, the third cost category in a manufacturing environment. What is manufacturing environment? Well, manufacturing overhead is simply all indirect costs. In other words, we could also say that it's all manufacturing costs other than direct materials and direct labor that are incurred, and yet they're related to the cost object. But these costs cannot be traced to the cost object in an economically feasible manner. So for example, the Chevy Silverado. What type of indirect costs would we have? Remember, these are all manufacturing costs. There are not direct materials and not direct labor. So manufacturing overhead is going to be the catch-all for everything else. Well, indirect labor, indirect materials, of course. Indirect labor, production management salary. Why would we classify a supervisor salary or production management salary? Because they're not on the assembly line putting together those units. What about the janitor's wages? The janitor inside the production plant, they're not directly making that Chevy Silverado, but they are in a support role for the production line. Grease for the wheel bearings. This is an example of an indirect material. It's a material we use. We have to have grease in the wheel bearings so they don't get too hot and everything and then blow up the wheel. But can we trace the cost of those tubes of grease in an economically feasible manner? No, we cannot. What about shop supplies, rags, toilet paper, paper towels, lubricants for the bearings and stuff like that on the machinery? Those are important, but because they do support production, and that's the key. All of these have got to be used in the production process. Nuts and bolts. Each car has nuts and bolts. What about plant utility cost? The cost of the electricity, the cost of the water, heating and cooling. Those are all costs that are involved in the manufacturing process, but we cannot trace the usage of each light bulb or each gallon of water in an economically feasible manner. What about plant property taxes? The property taxes in the plant. Can we trace those costs easily to one particular Chevy Silverado or a proportionate amount? No. So these are examples of indirect costs. These are costs that are not direct materials. They are not direct labor. However, they do support the production process. Anything that is not occurring in the production facilities, such as the CEO salary, such as depreciation on office equipment, and we're talking about like the home office or corporate offices, things like that. Anything that happens in a corporate office that's away from production facilities, those would not be any type of manufacturing overhead, and as we'll look at later, they will be considered period costs or not cost of the materials themselves. Now let's focus on cost behavior. Two main types of cost behavior we're going to see. The first one is variable costs. And variable costs, where are we going in here? There we go. Cost behavior one, there we go. Cost behavior one in two ways, variable costs. These costs remain in the same on a per unit basis, but the total costs incurred will vary in direct proportion to the level of activity. Fixed costs, these costs will change inversely on a per unit basis with the level of production, but the total costs incurred will remain the same. Now, sometimes a cost we encounter can have both a variable and a fixed component. These are called mixed costs, and we will look at that in a separate video, in my cost behavior video, and how we deal with that, how we separate the mixed components, the variable and the fixed costs, how we separate them to get so we can better estimate our costs. Then finally, we have relevant range. The relevant range is a normal activity level, where the relationship between the cost in question and the level of activity holds true. And we're going to take a look at that in just a little bit. So, one other thing we need to identify is a cost driver, and that's usually some variable cost, some variable. What is it, such as a level of activity, that causally affects costs over a given time span? So what is it? Some variable that if we incur more if we incur a total cost, what is the activity that's causing that total cost, that total variable cost to increase? The level of activity. The more we make, the larger the total cost. So that would be a cost driver. Let's talk about variable costs here again. Remember, I just said that these costs remain the same on a per unit basis, but the total costs incurred will vary in direct proportion to the level of activity involved. Here are some examples of variable costs. A worker's hourly wage. A salesperson's commission. If they get 5% of each sale, then the more units we sell, that salesperson will still get 5%, but that total cost of commissions paid to that salesperson is going to increase. Cost of materials used in production of goods. Shipping and delivery fees, for when we're shipping shipping products to our clients. Income taxes. Purchases of inventory. The more we purchase, the more we get. The more profit we make, the more income taxes we have to pay. And here's an example of the cost of labor. And let me just go over this real quick. Let's say we pay Johnny $20 per hour. Johnny only works 5 hours, so how much are we going to pay Johnny? Well, $20 per hour times 5 hours, the total cost of Johnny's wages is $100. But let's say Johnny decides, asks, hey, can I work more? So the boss puts him on the schedule and lets him work 10 hours. So with 10 hours of wages at $20 an hour, how much are we going to pay Johnny? Well, $20 per hour times 10 hours, $200. And then let's take a look, and let's say the supervisor is impressed with Johnny and puts him on the schedule a bit more the following week and gives him 20 hours worth of work. Johnny does well. Johnny does all of 20 hours, and we owe him $20 per hour. So how much are we going to pay him in total? $400. $20 per hour. That's where the unit is still the same. Remember, we saw the cost remained the same on a per unit basis. So per hour, $20, that's not going to change. But the total amount I'm going to pay him is $400. Now let's take a look at fixed costs. Fixed costs, remember these costs change inversely on a per unit basis with the level of production, but the total cost incurred will remain the same. So what are some examples of fixed costs? Well, fixed costs would be like warehouse rent, salary personnel, who get paid the same no matter how many hours they work, depreciation, and this is assuming straight line here. We'll look at the illustration there on the right of the screen here in just a moment. Property taxes. We're going to pay X amount of property taxes regardless of whether we make 0 units or 100,000 units of something. Plant insurance, loan payments, things like that. So those are fixed costs. Let's take a look at equipment depreciation. Let's say that our company, XYZ company, has equipment and we're depreciating $10,000 per year using straight line. Well, if I make 500 units of something, how much is my depreciation on a per unit basis? Well, my depreciation on a per unit basis is going to be what? 10,000 times what? Or divided by 500, and how much are we going to have? Let's get out our calculator here. And let's see. Okay, and our depreciation cost per unit is going to be what? $20. But now let's say that we make 3,000 units. Okay, so now we're spreading that same fixed cost over 3,000 units. So what is the cost of depreciation on a per unit basis? 10,000 divided by 3,000, and that'll get me $3.33. So let me just write that in here. So on a per unit basis, and I'm just going to write on a per unit basis, my costs inversely are inverse with the level of production. As the level of production goes up, my fixed costs on a per unit basis go down. However, my total cost here is going to remain the same. So that's where we talk about the cost change inversely on a per unit basis with the level of production, but the total cost incurred will remain the same in total. So let's clear that out. And let's get out of that. And now let's look at unit cost. Now the total unit cost, the total cost of an object is going to be comprised of both variable and fixed costs. Every cost object, anytime we make a unit or whatever, it's going to have some fixed cost built in with some variable costs. So the total cost of a product is going to be the total of the variable costs and fixed costs. Now, how do we get unit costs? Well, we take the total costs that took to make the widgets, and we divide that out, or we spread that out over the number of units produced. Now, when there's a change in the level of activity or units produced, a product's per unit cost will change. Now, we cannot, in basic general terms, the more we make, the less the cost per unit. Why? Because we just saw that the fixed costs go down on a per unit basis. However, our variable costs will remain the same, but when we add them together, we're still going to have a smaller cost per unit. But that's assuming that we're all within the relevant range. We can have a relevant range where variable cost per unit decrease or increase based on a level of activity. and that could change things. So we cannot just blankly say that the more we make, the lower the total cost will be. That will be true in a lot of situations, but there might be some there might be some situations where that does not hold true. So now costs can be classified as direct for one cost object and indirect for another cost object. And the same holds true in regards to cost behavior. It depends on the cost object whether a particular cost can be easily traceable to that or not easily traceable to that. So direct costs can be either variable or fixed. And again, I want to state that direct costs are generally going to be variable. However, there are occasions where direct costs can be fixed. But we're going to assume for our purposes that unless otherwise stated, direct costs are going to be variable in nature. However, indirect costs can be either variable or fixed as well. So let's take a look at, so we've got a little illustration here, a little table. We can have direct costs that are variable, direct costs that are fixed, indirect costs that are variable, and indirect costs that are fixed. So we can see any type of combination. So what does this mean in our decision-making process? Well, the decision-making process is going to be based on what is the type of decision that we have to make. If we have to make certain types of gap decisions, that we might want to focus on direct and indirect costs and ignore the fact whether they're variable or not for decisions regarding the income statement, gap, and so forth. However, if we're making management decisions, a lot of times we'll want to focus on variable and fixed. And we'll see this in another chapter when we're making decisions on whether we should take special orders, whether we should add a new customer, analyze customer profitability. So there's a number of reasons why we would want to separate variable and fixed costs, especially in a budgeting process and in analyzing our end results, end of the year results versus our budgeted our budget. Take our actual results and compare them to our budget, and helping to separate these direct costs will help us make better management decisions. Now let's take a look at some business sectors. We have service companies. If you remember from other accounting classes, we have three different types of companies: service companies, merchandising companies, and manufacturing companies. So let's take a look at service companies. Service companies provide an intangible service for their customers. So we're selling ourselves, our time, our expertise, our knowledge. Examples: H&R Block, JP Morgan, Progressive, Stanley Steamer, Orkin. These are companies that provide a service to their clients and their customers. So as such, since they're providing intangible service, they're not selling anything of material nature, so they carry no inventory in the balance sheet. What about merchandising companies? Well, merchandising companies will purchase inventory for the purpose of reselling to customers. Some examples of merchandising companies like Walmart, Target, Home Depot, Kohl's, Kroger, and the like. So anybody that buys inventory with the purpose of reselling to customers is going to be considered a merchandiser. And they do carry inventory in the balance sheet, and we'll typically call that merchandise inventory. How do we get the cost of merchandise inventory? Well, we're going to take our net purchases plus freight in. And how do we calculate net purchases? Our total purchases minus any purchase discounts minus any purchase returns and allowances. So the cost of merchandise inventory is going to be the net purchases plus our freight in. With manufacturing companies, these type of companies produce their own inventory for sale to customers. And these customers can either be other businesses or the retail consumers, what have you. Examples of this: Whirlpool, Tesla, the electric car company, Kellogg's, Procter & Gamble. These are all companies that make their own product and turn around and resell them to other businesses or to retail consumers. And what type of inventory will we have associated with them that's available for sale on the balance sheet? Typically finished goods. Now that's the main one, but we're also going to have a couple other inventory accounts there as well, but that's the main one. So we'll expand on the finished goods here. But they will have finished goods, work in process, and direct materials, and we will take a look at that in a moment. How do we calculate the cost of finished goods? On the balance sheet, direct materials plus direct labor plus manufacturing overhead with those completed units. And again, this is a very simplistic formula with regard to manufacturing companies. We'll actually expand that and get a lot deeper into that. But for each unit in finished goods, there's going to be a component of direct material costs, direct labor costs, and manufacturing overhead that's been allocated. So let's take a look at inventory in a manufacturing company. Now, the flow of costs in a manufacturing company through the different types of inventory on the manufacturer's balance sheet, manufacturing company's balance sheets, we're going to have raw materials or materials. Some companies call it just materials, some companies call it raw materials. Then we have another inventory called work in process, and then finally finished goods. The raw materials here, what are raw materials, or what are materials? These are materials that we buy from outside people, from outside companies, from outside manufacturers, and we purchase them for the intent of converting them into finished goods. So we buy these materials, and now we buy all the materials we need to make. And now, once we start producing some units, start producing some widgets or whatever it is we're making, we're going to transfer some of these materials to the production floor through a materials requisition process. And that's going to be now work in process. Work in process are any units started that we start to make, but we have not yet completed. So we start to work on these units by adding materials, but they're not completed yet. So so they're going to stay in here. But what do we do with completed units? Are they still in process? No. So then we're going to transfer them to finished goods. So we have three different types of inventory on a manufacturing company's balance sheet. The materials, where that is the cost of the materials we purchase from our suppliers. The work in process, the cost of units started but not yet completed. And then finished goods, these units are completed and ready to be sold to our customers. Now, we want to look at classification of manufacturing costs. Again, we already talked about these before: direct materials, direct labor, and manufacturing overhead. But now you see these as classification of costs. So we have those three classification of costs. Remember, direct materials, the cost of materials that are easily and economically feasible to trace to a particular cost object or a particular unit of whatever we're making. Direct labor is, we classify that as what? The cost of the people in the assembly line. Those costs are direct because we can easily and is economically feasible to trace those costs to the cost object. Remember, manufacturing overhead is the catch-all for every other cost of production or any other costs other than direct materials and direct labor that support the manufacturing process and any manufacturing facilities. Now I want to focus on inventoriable costs versus period costs. Inventoriable costs are also known as product costs. You can see those two are interchangeable terms. Some people consider them inventoriable costs. Some people call it product costs. And then we compare that to period costs. What are we talking about with inventoriable costs? Well, the inventoriable costs are the costs associated with the manufacturing of a unit, and when those units are completed, they end up on the balance sheet as inventory, and then once they are sold, then they are expensed off as cost of goods sold. So basically, it's any type of inventory we carry: merchandise inventory, manufacturing inventory, finished goods, work in process. These are all inventoriable costs because these are costs related to some portion of inventory. Now, only finished goods can be sold because we're not going to sell partially completed units. Our customers want fully completed units. So when I sell some of these finished goods, then I will expense it off as cost of goods sold in the period in which the sale is made. compare that to period costs. Period costs are those costs not supporting the manufacturing process or the manufacturing facilities. For example, research and development, design costs, marketing costs, customer service costs. Those type of costs that are on the other parts of the value chain other than the production part. So the other five parts of the value chain, R&D, design, distribution, marketing, and then customer service, those are all classified as period costs. The difference is these costs are expensed in the same period in which they occur, regardless of when we sell, because they have no direct tie to inventory. So we expense those off immediately. So if I have $500,000 worth of research costs, I'm not going to put those costs in inventory. No, I'm going to expense those off as a period cost, and then if I make revenue off that research and development at some time in the future, that's fine. But those would be types of period costs. Marketing, sales, advertising. Let's say I buy a full page in the New York Times. I buy the whole interior side of the second page. That would be an advertising cost. That cost, whatever it is going to be expensed in the period in which it occurs. Same thing with customer service. Any cost incurred with providing after-sales support would be a period cost, and we would expense those off in the period in which they occur. So only these costs right here, the direct materials, direct labor, manufacturing overhead, are going to be considered inventoriable costs. And why are they inventoriable costs? Because these costs are incurred and put on the balance sheet as inventory. And then as units are sold, those units are expensed off as cost of goods sold. Now let's take a look at inventoriable costs and period costs from the value chain perspective. Remember, the value chain is a sequence of events in which usefulness is added to a product. And remember, we talked in Chapter 1, the supply chain is a process involved in the production of goods and services for final delivery to a customer. This would include our company suppliers, as well as the production and distribution functions in the value chain. So everything associated with production costs right here, distribution costs right here, and would be part of the supply chain. But we also go backwards to our suppliers and to our suppliers' suppliers, all the way back to the very initial source of the materials. That is our supply chain. Now, across the value chain, only production costs are considered inventoriable. So any costs associating with this part of the value chain are considered inventoriable, just like what we just talked about. Costs associated with the other parts of the value chain consider period costs. So this is period costs right here for research and development. Design costs are period costs. Marketing costs are period costs. So are distribution and customer service costs. A couple more definitions I want to introduce to you that we should be aware of are prime costs. Prime costs are all direct manufacturing costs, such as direct materials and direct labor. Conversion costs are all manufacturing costs incurred to convert direct materials into finished goods. So we're going to separate our direct materials from all other production costs, and all the other production costs together such as direct labor and manufacturing overhead are going to be used to convert materials to finished goods. So those are, we talk about there, are conversion costs. And we are going to need to be able to identify what is a prime cost, conversion cost, because in some situations, we're going to separate our prime costs, direct materials, direct labor, and then our overhead is going to be separate. And then some other situations, we're going to look at direct materials by themselves and then conversion costs. And those conversion costs are going to be all the other costs other than direct materials that are lumped together, such as direct labor and manufacturing overhead. So let's account for inventory in a manufacturing company. Well, we have raw materials, and then what we talked about earlier, we have a work in process and finished goods. So let's take a look at our materials inventory. As we account for them, And we're going to assume in these scenarios here that we have beginning inventory. We have inventory left over from last month. Remember, beginning inventory this month is last month's ending inventory. So I have some beginning inventory plus materials purchased minus materials transferred to production equals ending inventory. So let me just do an example here. Let's say I had $2 in direct materials at the beginning of the month, and I had $5 worth of direct materials I purchased. What is my cost of materials available for sale, or available for use rather? Cost of materials available for use is my beginning inventory plus my purchases. So my cost of materials available for use, $7. Now let's say I transfer $3 to production floor. How many materials do I have left in ending inventory? I have 7 minus 3, 4. So my ending inventory for the period is going to be 4 units. Now, let's take a look at the next inventory. And let's say my work in process, so now we did that. So I had, $4 traced over. And in fact, I'm going to do this. And we're going to follow this through here. So let me restart my illustration here. I had $2 of beginning inventory here for direct materials. I have purchased 5, and I transferred 3 to the production floor. So I had ending inventory of $4 of direct materials. Now my beginning work in process, let's say I had $8 worth of costs in work in process at the end of last month. Well, I transferred during the month, I transferred $3 to the materials. So I had 3. Now what other manufacturing costs I have? I have direct labor. So let's say I had $1 of direct labor plus $2 of overhead. How much total manufacturing cost did I incur? I incurred 3 plus 1 is 4 plus 2 is 6. So 6. So at this point in time, I have what? I have $14 of costs involved in the work in process. $8 from beginning inventory that carried over plus the $6 of manufacturing costs incurred. Now let's say I transfer out units worth $7. So I transfer out units worth of $7, and the number of the units that are completed and transferred to the finished goods department that go down here are considered cost of goods manufactured. Cost of goods manufactured is not an account, but it's just simply a description based on the costs of units completed from work in process and transferred to finished goods. So I had $14 worth of total cost in ending in work in process. $7 went into was transferred to finished goods. So how much in cost do I have still left in work in process? Well, 8 plus 6 is 14 minus 7, and I have $7 here. Okay. So now I had, let's say in finished goods, let's say I had $11 at the beginning of the month. Added my $7 that was transferred in from work in process. My cost of goods available for sale. I have $18 worth of goods available for sale. Minus my cost of goods sold. And let's say I sold $15 worth of finished goods. So I had $18 worth of finished goods available for sale. I sold $15 worth of those finished goods. So that my cost of goods sold is $15. So what's my ending inventory then? 3. And basically, it's just tracing the costs as they go through the manufacturing process. And this is how we account for inventory in the manufacturing process. Now you've got to see the T analysis account that you first learned in financial accounting, that you're learning in intermediate accounting. A lot of what you're going to see in homework and tests and so forth, we want to really make sure that you understand is analyzing the T accounts. So you will see a number of different questions and everything where analyzing a T account will be the best way to solve to get an answer. So let's take a look here. Now, when we're accounting for the flow of goods in a manufacturing company, we are going to have, and this is an example of our multi-step income statement. In general terms, revenues minus cost of goods sold gives me gross profit. Minus my operating expenses gives me operating income. However, for cost of goods sold in a manufacturing environment, we don't just have one line item where we've expensed off merchandise inventory. We've got to actually analyze that finished goods account in order to get what our cost of goods sold is. So I want to take my my beginning finished inventory, minus add to that my cost of goods manufactured to get my cost of goods available for sale. Subtract out my ending finished goods inventory, whatever I have. I've gone through and counted, and I've got $776,250 worth of ending inventory and finished goods. So therefore, out of the $11,913 I had available for sale, I only have $776,250 left. So I must have sold $11,137,500. So my gross profit, just like we learned in financial and intermediate accounting, revenues minus cost of goods sold give me my gross profit. Subtract that from my selling and administrative costs to give me my total operating costs. Gross profit minus operating costs giving my operating income. Now, one thing I want to note here is that in order to compute this cost of goods manufactured, we are also going to have to compute a cost of goods manufactured statement. So if we want to know the cost of goods manufactured for the income statement, I've now got to do a schedule of cost of goods manufactured. So when I compute my cost of goods manufactured, this, if you think about it, and when we look at this, I'm going to calculate the direct materials used in production, direct manufacturing labor, and manufacturing overhead costs. I'm going to get manufacturing costs incurred during the period. So I'm going to analyze my direct materials T account to figure out how much I used in production. So let's go here. Take my beginning inventory and add together my purchases, subtract out my ending inventory, and that gives me my materials used. So the materials production, this would be materials used on the schedule of cost of goods manufactured. Manufacturing labor, we just trace those directly as we incur it. Manufacturing overhead costs, those we accumulate separately, but we add all of them together, and I get my total manufacturing overhead costs. So in the work in process, I'm going to take my manufacturing costs incurred, which is what? The direct materials used in production, direct manufacturing labor, and manufacturing overhead costs to get my total manufacturing costs incurred. I'm going to add to that beginning work in process inventory to get my manufacturing costs to account for, and subtract out my ending inventory, and that would be my cost of goods manufactured. And this amount here is what transfers to the income statement. So basically, this is just an organized schedule. You're going to pretty much follow the same structure all the way through. On occasion, you might see a schedule of cost of goods manufactured where your beginning work in process is up here. Add to that material costs incurred to get your, but the structure is going to be the same. We're going to add manufacturing costs incurred to our beginning inventory to come up with manufacturing costs to account for. And out of all those costs to account for, if I only have 1.25 million left in ending work in process inventory, then my scheduled cost of goods, then my cost of goods completed and transferred out to finished goods. In other words, cost of goods manufactured, 11,306,250. So the scheduled cost of goods is just measuring, is just a way to compute your cost of goods manufactured. So then that way you can on the income statement, you can compute your cost of goods sold, and that way you can actually go down the line and complete your income statement. Now, what constitutes direct and indirect labor? Well, there are some good questions to that. Direct labor, we already talked about, those costs associated with people assembling or working or completing a product. And we talked about some other types of indirect labor. Well, here's some other things that we have to look at from a management and accounting standpoint. Office staff for plant offices. That's for the person who, for the personnel inside the plant office. That's indirect labor because they're inside the office supporting the manufacturing, the facilities. Rework labor. What is rework labor? Well, let's say something comes out defective, and we determine that instead of throwing it away and scrapping it, we can just add a little bit more materials, add a little bit more labor. We can redo it to make it a perfectly good unit, to make it that unit perfectly good and acceptable to our end customer. Well, the cost associated with adding additional materials, labor, whatever, the cost of reworking a unit would be indirect. And then labor would be indirect labor. Another example of indirect labor, overtime premium. We talk about overtime premium, we're talking about the dollar amount above their normal salary. Overtime, when we pay someone overtime, we usually pay them, by law, we pay them 1.5 times their normal wages. So if someone's paid $20 an hour, and they're now worked their 40 hours, and now they're on overtime, how much would they make? Well, they would make 30. 20 plus the extra 50% markup because of them being on overtime. That $10 above their normal hourly wage is going to be the overtime premium itself. Then we have idle time. Idle time is simply where a machine shut down because it's broke. Maybe there's nothing to do, there's no work, production, whoever did the production schedule messed it up, and we don't have anything that we can produce, anything we can work on. So idle time is when the machine's not running when it should be. And there's manager salary. We talked about that before. And then fringe benefits. And you see I got a little footnote there. Fringe benefits, how do we treat that? Well, there is some discussion whether it should be treated as direct labor or indirect labor. In my opinion, as the footnote states down there, fringe benefit costs should be considered direct labor costs in addition to the hourly wage for those employees who are considered direct labor. In other words, anybody who's considered direct labor for any other type of cost measurement, the cost of the fringe benefits associated with that employee should also be direct, such as vacation, sick pay, and so forth. Why? Because, and this is usually because the company will have to offer fringe benefits in order to entice employees to work for the company. I mean, if I offer you $30 an hour, but I'd say, I don't feel like giving you benefits. And Joe Blow, next door to me, in his company, he offers you $25 plus fringe benefits, then, or even $30. Let's say he matches my hourly wage of $30. I offer $30. He offers $30, but he offers fringe benefits. Are you going to work for him or are you going to work for me? Well, you're going to work for him. So the only way to entice you over to work for me, one of my enticements is going to have to offer you benefits for people to come work for me. So that's why I prefer, in my opinion, that fringe benefits, if it's tied to a person who's otherwise classified as direct labor, the cost of that fringe benefit should be direct labor too. What about those employees who are considered indirect labor? Well, in that case, then I think that we should classify those fringe benefits as indirect labor costs. So, and then some people would assume that, hey, they should all be either indirect or direct. My opinion is, depending on the normal classification that person is direct or indirect, their fringe benefits should be the same. So, Now, one last thing I want to talk about here is the cost in the value chain, different costs for different purposes. As you see there on the screen, um, for traditional product costing, using generally accepted accounting principles to record amounts for financial statements, only the costs of production here in the production part of the value chain are inventoriable costs. But under the cost reimbursed for government contracts, we're going to include our production costs, our design costs, and then some, usually not, but in some cases, we can also claim research and development costs as a cost of our product. And then let's say cost for pricing and product mix decisions. Well, if we're trying to determine what's the total price we're going to apply on this product, well, we have to consider all costs throughout the value chain, because I can recoup my production costs, and that's fine. Let's say it cost me $5 per unit to make, and I sell it for 10. Great, I made $5, but that $5 has also got to cover design costs, research and development costs, marketing costs, distribution costs, and customer service costs. Now, that $5 has to cover a lot of other costs. So if I just focus on production costs and get that $5 profit, well, what if I have $8 in costs associated with the rest of the value chain? Now, for a long-term pricing strategy, every unit I sell, I'm losing $3 when I take those other costs into account. So therefore, for pricing and product mix decisions, I want to take costs along the whole value chain. So that's when we talk about different costs for different purposes. What is the purpose we're looking at costs? What is our cost object? Because if we have a different type of object that we can cost in different parameters, well, if I'm selling to the U.S. government, they're going to allow me to design my product as well as produce it. So at least minimally, I get these costs built in to the sale price to the government. So I've at least incurred these. So, and at least I got that money back. So we'll incorporate design costs, production costs, and then add a fair markup to that. So that's what we talk about with different costs for different purposes. Certain purposes such as GAAP, the SEC, financial reporting, I'm only going to use production costs. However, for other types of decision-making processes, it depends on that situation, what costs I'm going to include in there. So, and again, for pricing and product mix decisions, all costs across the value chain should be included. And in the decision-making process, there are 5 steps. First of all, when we're making decisions, we got to figure out what is the problem. What is it we're trying to solve? What is the uncertainty that we're trying to build certainty into? Once we've identified the problem, we want to get as much information as we can. And the reason for that is we need to have information so that way we can analyze the situation. And once we get the information, we'll analyze it. We'll make predictions about the future. Well, based on the information, I can have 3 alternatives. I can either do A, B, or C. Based on the information, I'm going to make predictions about the future. If I take route A, what do I expect will happen? If I take route B, what do I expect will happen? And route C, what do I expect will happen if I choose that alternative? And among those 3 alternatives, A, B, and C, once I made predictions about them, I've got to choose one. I got to choose A, got to choose B, or choose C. Maybe some situations where I choose 2 of the 3, but then ignore the third. So I could choose multiple alternatives if I need to in order to combat a problem. And then finally, once we've chosen their alternative, we implement the alternative chosen and evaluate the performance. If I choose something but do not implement it, then it has done me no good. I can make all the New Year's resolutions I want to drink only water for the next 90 days. But if I don't implement that decision and actually work that out and actually only drink water for 90 days, then that decision, while it may have some good side effects, if I don't implement the alternative, then, and I don't ever start on that water diet, where I'm just drinking water, then it's done me no good. I can say everything I want, but until I actually implement the decision, then then I've done no good. So now the first 4 steps are planning stages when decisions are being made. And when we're making decisions, we're going to see this a lot, in the planning stages, especially when we're planning budgets and so forth. Remember, budgets is our quantitative expression of the company's strategy. We're planning things. We're forward looking. The last step is known as control and learning. And this is where we will evaluate the results of the decision that was made. So we'll look at, after we implement, we'll measure it as we go along, and then also at the end of whatever the decision is or the investment is or whatever it is. As we're working through that, we're going to evaluate the results of the decision and then compare that to the anticipated outcome. And we're going to see. And unless we have a crystal ball, we don't, our outcome is not going to expressly match what we anticipated. So we're going to investigate the factors that cause results to differ from planned outcomes. And then after investigation, we can provide feedback so decision makers can make better decisions and better plans in the future. So, and one last thing in the decision-making process I want to touch on is a focus on relevant and irrelevant information. Relevant information in our decision-making process is relevant revenues and relevant costs that occur in the future and that differs among alternatives. So if I'm going up here to making predictions about the future, if there's a line item or a financial line item or something in a financial decision making process, the only relevant information are going to be the revenues and costs that differ among differ among the different alternatives. Anything the same or any other information is irrelevant. For example, if I go out to buy a new car, let's say I'm going to pay $25,000 for this new Toyota. What is a relevant decision? Well, the decision would be a relevant decision in my decision-making process, whether I want to keep the car or keep my piece of junk car or buy a new car. What's relevant? Well, the operating costs probably, because I would imagine that my old rust bucket is probably going to be more expensive on as far as how much gas it uses. So the amount of operating costs are going to differ. So between keeping it, because my cost of keeping my operating cost of keeping my junker right now is going to be higher than if I buy a new car. What would be what would be an irrelevant decision? An irrelevant decision is like a sunk cost, anything that's already happened before. The purchase of my old car, my junker, that beater, I can't change that. It's not in the future, and it does not differ among alternatives. So therefore, it's not relevant in the decision-making process. So relevant revenues, relevant costs, they occur in the future. So they have to be forward-looking, and they have to differ among alternatives. Now, let's say that I have a beater, it's paid for, and now it breaks down. And let's say it costs $20,000 for me to fix my car. And let's say the cost of a new car is $20,000. Does the cost of that new car, is that relevant now? No, it's not, because either way I'm going to spend $20,000. Whether I buy a new car or spend that $20,000 fixing up my junker, that does not differ among the alternatives. Other key factors will, such as operating costs of the car, maybe insurance and so forth. Those may be relevant because the cost of insuring a newer car is going to be more expensive, most likely, than the cost of an older car. So that would be different. But if I'm going to spend $20,000 either way among alternative A or alternative B, then that $20,000 spent in and of itself is irrelevant. But any other costs or anything else in that decision-making process, that will occur in the future and differ among alternatives is going to be relevant. So that concludes this session. Thank you for being with me, and I look forward to seeing you again.